level at different times, making it more powerful. More rejections are better, but it won't guarantee that the level will hold. When the market taps into a level, we closely watch price action to indicate what is happening. If the rejections are getting weaker every time, there is a higher chance for the price to break through this level, but it will be strong support if the price reaches this area again. Number 3. Acted as both support and resistance. If a level of market structure has acted as both support and resistance previously, it increases the probability for the price to reject this level again. Number 4. The move away from the area was drastic, meaning that not a tiny reaction but a true reversal. The deeper the return from a level, the more important that level is. Number 5. Recently respected or created levels. The recent levels in front of the price are always more effective since they are current and new, whether they are traditional support, resistance, or order blocks. Now, with all being said, let's zoom into the 4 hours time frame to continue our analysis, which is where the smart money concepts come in. Here on the 4 hours, we have both weekly and daily levels visible on the chart. Each of these levels can act as strong support or resistance when the market reaches them. So we use these levels in two major ways. First, breaking each one into the up or down sides indicates whether the supply or demand is in control and price can continue pushing to the next level. Second, we use them as our higher time frame targets for our trades. So, the 4 hours is when we fully apply smart money concepts, which includes identifying market direction, supply and demand areas, order blocks, fair value gaps, liquidity zones, and possible trade opportunities. So here, the market has recently broken below key daily level with momentum, which indicates that supply is in control. Currently, we have an inefficient move that created a fair value gap and a break of structure. So the candle that created the inefficiency is our order block zone, which could give us a possible short entry. But we cannot place sell limits on this order block since the price has rejected a key daily level, which could be a turning point for a short-term downtrend. So we need to have bearish confirmations in lower time frames like 15 minutes to enter short positions. On the other hand, if the price breaks above both levels, it indicates a strong bullish momentum, which could make the price rise and test this weekly level one more time. Now let's zoom into the 1 hour's time frame to continue our analysis. Once again, we fully apply smart money concepts, including identifying market direction, supply and demand areas, order blocks, fair value gaps, liquidity zones, and possible trade opportunities. We know that higher time frame directional bias is bearish, and we expect the price to get rejected from the 4 hours time frame order block. After mitigating this daily zone, market is making a deep retracement and creating liquidity zones before reaching the 4 hours order block, which is another confirmation. Right now, the price is in a short-term uptrend, and an ideal situation would be for the price to change the direction where 4 hours and 1 hour will be in the same bearish direction. So far, we have applied price action and smart money concepts perfectly on the charts, and we have a 4 hours order block, which is an area of interest for trading. It is important to note that, for a 4 hour time frame order block, we look for confirmation in 15 minutes, and for the 1 hour time frame order block, we look for confirmations in 5 minutes. So here the 15 minutes chart is the last time frame we will analyze in this process. In this time frame, we only look for confirmations and enter the positions. So first, we need the price to enter the order block zone and create a change of character to confirm that the short-term uptrend is over and the market can continue pushing downwards. If we see no change of character, we won't have any trade. Our first target would be this daily level in front of the price, and if the market could manage to break this area, it can continue pushing downward to reach the next weekly level in front of the price. Now this setup was just an example of how to enter a trade, and you could use multiple price actions or smart money strategies to enter the market. But remember, before using any setup with your real account, you should backtest it on different pairs to evaluate the trading strategy's performance using historical data. Backtesting allows traders to build the required confidence and prepare for potential risks associated with their strategies, optimizing their trading strategies by fine-tuning parameters and rules. But unfortunately, it could be very time-consuming. That's why we use Trader Edge to backtest and keep track of all trades. Let's suppose we want to backtest crossover trading setup on the euro-dollar in 1 hour time frame. We will first set up the chart on TradingView and adjust it. Then we will open TraderEdge's backtester and arrange it next to the chart. Here we will input our starting balance and risk per trade, which we've set to 2%. You can change this to any value you prefer, whether in dollars or percentages, for each individual trade. Once we're done with the backtesting, TraderEdge will provide us with a detailed matrix, including important information such as win rate, maximum drawdown, and profit results. It also allows us to save the data and add more backtests, which will all be stored in the strategy library. If you're interested in using TraderEdge, you can sign up for a 7-day free trial by checking the link in the description. Now let's apply multi-timeframe analysis to another pair to understand the concept completely. Let's continue our analysis with the Aussie dollar. Here on the weekly time frame, these are the only visible weekly levels near the current price, so we draw them in. Now let's move on to the daily. In this time frame first, we adjust the weekly levels to get the greatest number of touches and draw additional daily levels if they are obvious. Now let's jump into the 4 hours. Here on the 4 hours chart, we have a bearish bias. After mitigating this daily level, the market has made a deep retracement to this order block zone. So here are two scenarios. If lower time frame price action shows bearish signals at this order block, we could go short, and our primary target will be this daily zone and our secondary target weekly. On the contrary, if the market manages to break and close above the order block, our 4 hours directional bias will change to bullish, and we expect the price to reach the daily and weekly levels in front of the price. Now let's zoom into 1 hour's time frame to observe more details. Here on the 1 hour chart, we can see a lot of price action signals. After mitigating this 4 hour order block zone, the market made a change of character, which signals that the short-term uptrend is over, and price can possibly continue pushing downwards. Here we have a perfect opportunity at this 1 hour's order block to go short, and our first target would be this daily level, and we could use this weekly level as our long-term target. Right now, there is no need to look for confirmations in a lower time frame unless someone wants to look for more trades based on the analysis we made. But remember, more trades do not mean more profits. So guys, I hope this video provided some value for you. If it did, please hit the like button to show your support and subscribe to our channel if you're new. Also, don't forget to comment below with your thoughts and questions, since we do our best to answer them all. See you in the next episode.